So easy to buy a business, so hard to make it work.
Do you have a little bit of sympathy for them?
No.
No sympathy.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Sophie Downes, your host for this week. Today on the show, a sudden fund closure sparks frustration for wealth managers. We lift the lid on Isio's acquisition of Collider. And finally, why the private equity fairy tale doesn't always end happily ever after. Joining me to unpack this are two Citywire journalists, Dylan Lobo and Gilbert, as well as James Sullivan, Head of Partnerships at Tyndall Investment Management. So welcome to the studio, James.
Thank you.
So Dylan, let's start with you. You covered the closure of GIB's Emerging Markets Fund this week. Now we see a lot of fund closures. Why is this one in particular causing frustration for wealth managers?
Well, this one is a little different, Sophie, in that this fund was actually doing quite well. It had a bad couple of years. It launched in July 2022. First 2 years, bottom quartile. This year, things clicked, and it shot up into the top quartile. Now, GIB, which is it's led by former Alliance Trust CEO Catherine Cox, of interest, was on a global roadshow last year, taking the fund managers of this emerging markets fund to Citywire Montreux, Citywire Miami, and loads of other events promoting this fund. Fund selectors bought into the story. And then 3 weeks ago, I found out that GIB was closing down its active funds business, which meant this fund was closing. Now, this story that I wrote this week is about the frustration and the disappointment among fund selectors that this kind of having done all this due diligence to get the fund into portfolios, which can take months. Suddenly, the fund closes.
Mm-hmm. But if we were going to look for positives in this story, it's actually quite novel that an asset manager has decided to actually close a fund or funds if they've determined the market demand isn't there and they're not appealing to a broad enough audience. Because what we probably don't need are more funds coming to market, especially whilst the market's moving towards lower cost passives.
Has this happened to you before, out of interest, where you've kind of bought into a fund or a story and then kind of had the strategy closed down due to corporate decision?
No, not that I remember.
Okay.
Or as a politician may say, it's not a scenario I recognise. Dylan knows I've been doing this a long time, so maybe there was once upon a time, 10, 15 years ago. But nothing springs to mind. I think part of our process is trying to identify funds that are sort of relatively small but growing, rather than funds that are sort of stagnating or on the back foot, because that's always a bit of a precursor.
Yeah, I mean, on that point, I will say that there was money coming into the fund.
Yeah.
It more than doubled in assets. So it was starting to, the subscriptions were all coming in. So these investors kind of sort of employed the kind of your philosophy, and then were told shortly after that this fund will no longer be.
Yeah.
So do you have a little bit of sympathy for them?
No.
No sympathy.
Of course I do. I think if you open up to a broader conversation about active funds in the London investment community, the active element of our industry does need to bring down costs, as painful as that may be, and pivoting a business model towards sort of lower margins. That's going to come with a lot of pain, and running an active fund business is very, very expensive, not just from a compliance and oversight perspective, but the infrastructure. This particular fund, I believe, was employing 3 or 4 senior fund managers. Fund managers are not particularly cheap, so we may determine that $150 million or so is a nice size for a fund, but is it profitable at $150 million? Possibly not.
Mm-hmm. And of course, as the industry continues to face these kind of pressures, we're also seeing providers looking to increasingly diversify the revenue streams coming in. So this week we saw Isio's acquisition of Collider, which they made very clear to us was just the start of a very aggressive M&A strategy. So I mean, James, when a pensions heavyweight like Isio buys a $3.8 billion tech and MPS firm, what does that signal about where the industry is heading?
US-backed firms buying businesses within the UK financial services industry is not new. We've seen that for the last 10 years, really, since we had the suppression of rates and sort of easy money and debt was very cheap. What's relatively novel about this is that it is not simply buying an advisory business. It is buying a tech-based MPS/DFM business. The MPS business in the UK is already quite well served. So there needs to be an angle to make it stand out. Is that the bespoke element of the product? Is it the tech, AI-driven element of the product? Whatever it may be, there needs to be something to ensure the product stands out above, its relative peers. What was quite interesting in the story, I think I picked up on there was not going to be a sort of harmonization of the two product offerings or the two teams. That'll be interesting to see how that develops, because I don't quite know how you then differentiate the product to the audience. Also a sort of a global investment consultant buying essentially product and distribution will always be interesting to observe, and not unique to this deal. We saw, I think, Willis Towers Watson buy into
the Atomos deal,
Atomos a year or two ago. They've just got to make sure that the disclosures of independence are sort of properly articulated in the right manner, which of course they will be, I'm sure.
Dylan, let's consider the flip side. So you took a look at under the bonnet at Collider's accounts. Did they shed any light on why they might be looking to sell?
Let me just state that there were 3 bonnets. So they're quite a sort of a convoluted structure. I don't know if convoluted is the right word, but when you combine the 3 entities, the profit was, I think, 300,000. So for a business with 3.8 billion in assets under management and advice, that's not a huge profit, right? I mean, so this, you're probably thinking, look, we've in a way, Collider feels like it's a bit ahead of its time as well. 2010, this tech-based firm, and I think they're, from what I know and what I've heard, their tech is pretty neat, but they're not making money from it. Income, Isio with the backing of the US PE firm Aquiline, and they can really, there's a lot of potential, I think, to scale this business up.
Okay, so we've got Isio clearly in a buying mood, but we know that M&A doesn't always work out happily ever after, especially when private equity is involved. And that brings us quite nicely to our final story, which is Carlyle selling off the 10 billion wealth firm Hurst to Shackleton. So Jack, you wrote a piece on this. Tell us what's going on.
Yep, so Shackleton bought the £9 billion wealth management group Hurst, which I think was your scoop actually, Dylan.
Yeah, thanks. It was.
Yeah.
Thanks for the shout out.
Another private equity backed deal in the wealth space. Shackleton Advice Consolidator, Hurst, it's an advice group, and a DFM Hawksmoor. And on the surface, obviously, this looks like another kind of big takeover in that space. But after Dylan ran the story, we spoke to a few contacts who kind of said, actually, the deal price, which wasn't publicly disclosed, was looking quite low. Figures putting it between 180 to 200 million pounds, which for a business with 9 billion of assets, 90 odd planners, like 30 odd investment managers, is a pretty low figure for this kind of business. And particularly given Carlyle has invested a lot of money in it, they bought up a lot of IFAs, they bought Hawksmoor, they bought some bigger advice businesses to start it off. So it looks like this wasn't a real kind of happy ending, as you said, for Carlyle.
Why was the price so low?
Good question. Well, we did some kind of digging into it, looking at the numbers. We tracked the RP leaderboard. You can see that their planner numbers had fallen from about 105 in 2023 to about 90. So they lost planners, which is obviously not unique to them, but some businesses are more affected by this than others. And then on the DFM side, they've also had challenges. So a story I think, Dylan, you broke as well about their 166.
This is great.
They had a Section 166 from the FCA, which lasted 2 years, and they lost a team of wealth managers to a rival Oberon last year, which led to a kind of a bit of a messy lawsuit, which was then settled. So they had some challenges on the DFM side too, and I think that potentially points to why the deal price was certainly lower than others that we've seen in this space.
Well, if we open up story to the room, and I'm intrigued to hear whoever's opinion on this, do we think that this Hurst sale is a one-off, or are we about to see a lot more of these kind of PE-backed deals slightly unravelling this year?
I think I think we're getting to the stage where we're now sort of 5-10 years in, post the point where PE acquisitions of UK businesses really sort of kicked off and accelerated. And my feel is that a lot of these private equity firms, typically based in New York, are relatively disappointed in the returns they've been getting for the investment they've made. a couple of points I would make is that building a successful asset management or any financial services business is not as simple as putting a spreadsheet together and aligning the numbers, and then you're going to get spat out a huge dividend at the end. It's much more about the harmonization. I think we used that word earlier. It's about making sure cultures and values fit, the product suite is chiming, and it appeals to the client. And I think that's another very, very topical and pertinent point to make. Typically, I'm not saying it's the case here, but private equity is not perfectly aligned with all stakeholders of the business. And within stakeholders definition, I include the clients. A private equity cycle typically is 5 years, give or take. When we speak to clients, we always guide them towards a minimum investment period of 5 years, typically. It might be 3, but broadly 5. The cycles are just not aligned. If you work for a big private equity-backed firm, I think there's a degree of insecurity and uncertainty. At what point are we going to get flipped? Which
happened to Hurst Point, obviously.
Which happened to Hurst Point. So easy to buy a business, so hard to make it work.
And I think that's what we saw with Hurst Point. They bought a lot of businesses, but they didn't see the value of the businesses increase over time.
Yeah. You don't buy 3 businesses and it's sort of 1 + 1 + 1. You're lucky if you get sort of 1.2 at the end of it. The harmonisation and synergies don't equate to 3 in that instance.
Yeah. Well, thank you for joining us, everyone. And that is all the time we have for today. A massive thank you to our production team and to our guests, James Sullivan, Lobo and Jack Gilbert. We'll see you next week.